To have with us today Dr. Iftikhar Hassan. He'll be presenting on political ties and raising capital in global markets, evidence from Yankee bonds. Dr. Iftikhar Hassan is the university professor and Gerald Corrigan Chair at the Gabelli School of Business at Fordham University. He serves as a scientific advisor at the Bank of Finland, a fractional faculty at the University of Sydney, a research fellow at the Financial Institutions Center at the Wharton School, as well as at the IWH Institute Halle, Germany. He is the managing editor of the Journal of Financial Stability and has served as an associate editor in several other reputed academic journals. A Fulbright scholar and a Fulbright selector, Dr. Hassan held visiting faculty positions at several research universities across continents. Professor Hassan has over 335 publications in print, including 16 books and edited volumes, and over 250 peer-reviewed journal articles in reputed academic outlets such as JFE, JFQA, ROF, and others. Dr. Hassan is a recipient of the prestigious Changjiang Scholar Award from the Chinese Education Ministry and received a Doctor Honoris Causa from the Romanian American University in Bucharest. So please help me in welcoming Dr. Hassan.
Thank you.
Thank you. The floor is yours.
Good afternoon, everyone. Professor Dagger and the Institute, I thank you for inviting me to your university to give this talk. So it's my pleasure. Thank you, everyone, for showing up in this late afternoon. So I'm going to talk about some initiative I have taken. And honestly, this is the first time I'm giving this paper. Actually, the whole idea about this paper is about two different ideas I've been thinking about. And I'm going to tell the story through this idea, but I will share with you what I've been thinking about. And this particular idea comes from the fact that that I'm new into this area. It means I'm a corporate finance banking guy, but here I sort of got newly into this area of financial economics, political economy, and also thought about the aspect that the whole world, if you look at the rating agencies, you'd find out there are 3 rating agencies, maybe 6, but 3 of you know more. They are actual monopoly in the entire world. And the decision making, so in some sense, if you really think about a rating agency, so we talk about agency problem, even though this paper is not about the agency problem. So every organization is an agency problem. And all of us over here, one way or other, we talk about agency issues. So if agency issues exist in everywhere, whether it's academic institution, whether it's a corporation, agency issue also exists in the rating agencies. So in some sense, you don't have to do anything. A rating agency can create a 1 quarter, 25 basis point changes in your rating. You suddenly can see a transaction of $500 million took place. So actually, that thought process actually motivated me to get into this particular project. But here, I am looking more from the corporate aspect in fundraising across different countries together. And you can see the motivation of this paper comes from number of news items that you see over the time. You can see that particular Russian company got into trouble and immediately it lost 50% of its value in the Hong Kong stock market. And I brought many, many examples. And each of these examples you find out either the US has a sanction or the rating agency has created an environment, and you find out multi-hundred millions of dollar fine and transaction taking place. So in some sense, you can see that
Rusal was reinstated, I think.
Which one?
Rusal, the first one, the aluminum company was.
Yeah, the price has gone up later on.
It has gone up, yeah.
Yeah, but it did not.
Because it's the largest aluminum.
Yes, in Russia.
In the world. And
yeah.
Not just Russia, but in the world.
Yes.
And so, the U.S. couldn't maintain the sanctions.
Yes, yes. But the point is that you can see that the sanction that is coming from U.S. has a significant effect in your ability to keep your prices the same it is or to raise new funds. And I brought example from different on Russia, Turkey, and Venezuela, and so on. And so you can see that. And here, if you look at the federal corruptions, foreign corruptions enforcement actions, and you can see that large number of companies has a here you can see that company's name, and country and the amount of money they have come to settlement with the SEC and others and so on. So you can see the huge amount of involvement of the US administration, regulators, or the SEC in creating. And since it comes down to billions of dollars only in the top 10 penalties. So motivating the paper, actually, even you can see this company, German-based Allianz company, they were involved in something completely different somewhere else. But US Security Exchange Commission could manage to create a significant amount of fine coming out of that by accusing that their involvement, and it was in Indonesia, in different place, but even in Indonesia, even though the companies involved were not American companies, but given they raised fund in the US, under the US law, they created an environment to be able to find this particular organization. So the motivation of this paper is more about, if you have a bad relationship with the US, it's going to cost you. And in this particular case, it is, if you have a political ties with the US, actually it ends up being a put option. You create an environment that protects you against the country's risk, and you are able to create some sort of investors' protection. Now, even though these events that I talked about, these are extreme tail events, and not necessarily is on the mean. But our perspective is that if I really want to disentangle this effect of ties, I need to create a empirical validation. And I want to mention that I didn't highlight this previously. This paper is written with a co-author, young man, is Jean Ambrosio, and Guxian is at Central University of Finance and Economics in Beijing. So they are both young people, have been instrumental in being a co-author, and most of the hard work has been done by them. So I wanted to recognize that. So here, how do you measure the state-to-state political ties? And how do you disentangle effects of ties from the changing domestic financial conditions? So in some sense, there could be political ties, and somebody could think about how to raise funds, how to raise bonds in their own market. So in that case, if you think about raising the money in your own market, then the environment of your own market, economy, other uncertainty comes in. So in this case, we cannot disentangle exactly where it is coming from, but we consider Yankee bonds. And Yankee bonds is, most of you might know that is a bond that is denominated in US currency, but they all are in the US market, and they are under subject to SEC requirements. So it is just like any American bond issuing, and it creates additional certification. And this market is huge. And I'll come to that in a second to show you how huge is this market. Where is that, my graph? I thought I have a graph that shows that amount is over $1 trillion just in the last few years. So it's not about a few $100 million involved, it's $1 trillion. Altogether, it is a $6 trillion market. The overall $3 million over the time is in the Yankee bonds. So here, so we try to look at how these political connections take place. So here we are trying to see how the country's state-to-state connection works. How many minutes do I have?
Okay, so
I want to allocate it accordingly.
you can have another 25 minutes.
25 only? Okay. Because I want to tell different stories. Yeah. So in some sense, you could look at, so we trace the voting pattern of each of the countries in the sample, and we see in the UN how they are voting with in this particular case, with the US. So this is not our innovation. People in the political science and in financial economics, they have done extensive work. So some of this data we are getting from other people about creating how they are voting. So in some sense, they are voting against US or in favor of US. There's 2, 1, and 2 score. And the second time, we are looking at the voting between 1 and 2 and also abstain. And creating that, we create an index about their voting pattern. If you look at the results, it's a significant result with regards to 1 standard deviation increase in political ties could lead up to 5 to 14% reduction in yield spreads. Now here, this is not the basis point. Basis point, it is between 30 to 70 basis point. But overall, 15% reduction in your cost could be coming on if you have a 1 standard deviation change. If you look at the amount of issuance, it's a 50% increase in the amount of bond raised and 30% increase in maturities. And so I'll come back to this more in details. So given the time, I'm not going to spend a lot of time on literature, but only wanted to say what has been done in the literature so far. People have looked into with regards to the political ties and borrowing cost. So these things are more about democracy. I have done some work myself in this, creditor protection, regulation from home country and US, and cultural distance. People have looked at how much it costs for banks to borrow money, a different sort of literature. There's a literature about political connection in firms, lots of paper about if you're politically connected, how it impacts your borrowing cost. And there are also papers on media coverage and human rights violation. Very fantastic paper. Actually, this is the first paper that motivated me to write this paper. It's Journal of European Economic Association's paper. This paper actually shows, by taking 40 years of data, that US State Department, and it's just normal, they provide information as much as possible to the general media about what they want to say. So anybody who comes into the Security Council, a Security Council non-permanent member, and they continuously would bring human rights violations news. And the news would come in. If you are an allied country, it would be positive news. If you're not an allied country, it would be negative news. So journalists who are writing this article, they are people like you and me. They're doing their work. So whenever they get any information, they have a deadline, they quickly get the information. So this paper traces three newspapers, New York Times, Washington Post, LA Times, and they find journalists exactly go and take the things that come out from the US State Department, and they follow that, and they find out that the media coverage is completely coming in from the government-involved media news that comes out. It is nothing intentional, personal, but the journalists simply get the news what they have, and that creates a pressure on the new Security Council member. So what we do is we take the Yankee bond market to look at all their data, and you can see here, and here itself, almost $1 trillion is coming in even in 2017. So it's a huge market. So we look at the data for 1992 to 2015, and we look at 450 firms, 49 firms in 46 countries. So we look in this particular paper spreads and as its impacts by all relevant variables that people have used in the past. So here I will show you some results in the very beginning about voting A and B with two different categories. And we're also creating US aid. So US aid is also a measure for political connection. Here we take the total economic aid obligation, and we also take total economic and military aid obligation, and we create two different variables. At the end, we do a PC, principal component, and create some measures that brings both of them in a separate variables, and all the results we are giving it through the index that we created from this voting A, B, and economic aid A and B. And if you look at the spreads, you can see there's a huge range of spreads, and ratings are different, maturities are different. And so in some sense, the paper has a lot of variability. And so by nature, the numbers means are zero, but because by nature, you can see that some people are voting with the US, others are not. So it is more, the story is here. And in some sense, you could see, not necessarily, you can see Argentina voted not voting with the US at all, as much, but they get quite a bit of aid. Whereas Australia is always voting, Australia, UK, and France, you'll see these three countries are continuously voting with the US, but they are not necessarily in the front end of the aid. So what I'm trying to say is that these two variables, voting and aid, is not necessarily correlated. So we get a really good idea about the perspective on political connections. Huh?
Why is China giving USAID?
China did. China is only, recently they are not getting as much economic aid anymore, but historically in 1990s, China has got money even from the World Bank,
Yeah.
and others, yeah. So don't have to spend a lot of time. You guys can simply see that this is the focus of the variable, and we're looking at here spread, yield minus treasury bill, and we are looking at that. So here you can see that all variables A, B, economic aid, overall aid, and deviation of the aid from the norm. That means we want to say it's not the level of aid. Suddenly there is a change of the aid, how that impacts, and we find in pretty much every possible case, expectedly, that if you have a higher political tie, you end up paying lower yield. So your cost of borrowing is significantly lower when you have a strong political tie with the US. Then we take this principal component variable.
So it has nothing to do with your financial statements, profitability whatsoever.
We control for everything else.
He's
Yeah.
going to control for all
Oh,
of
you're
it.
Yeah,
controlling for
controlling for everything.
Because otherwise then you couldn't identify the effect.
Exactly.
Yeah.
Yeah. Also, we control for all the literature variable that we talked about, cost of borrowing. So every one of the variables, whether it's democracy, whether it's the differences in culture, all this variable comes into the independent variable. And then we are focusing to see, controlling for everything else, does political tie matters or not?
What about American share ownership?
American
Share ownership.
in
Control for that
American share in the
in the foreign firms.
in the foreign firms. No, we didn't. So in the sense you're trying to see, we'll be able to do only one thing. We would not be able to, we'll be able to see the amount of institutional investors associated with this particular share. We did not, but it's the data, I have access to this data that shows all the institutional investors in the foreign countries, and it is a good suggestion. So you were trying to say that if the U.S. investors are involved, it's going to give a confidence to the buyers, and that could influence that. Yes.
A related question to the one shared with our colleagues. Do you think that the decision to issuing a Yankee bond is endogenous to some factors? So why in the U.S., not in another country? And maybe use the foreign shareholders as an instrument for that endogeneity problem?
No, endogeneity problem will solve differently, because if you want to think about self-selectivity, we cannot do a Heckman here because we do not have companies. In that case, you have to take every company which is issuing or not.
Yeah.
Here, they have the possibility to go the Japanese bond. They have a Japanese bond.
Exactly.
They have a European bond.
Yeah.
So in this case, we can do that easily. But in this case, we have to take every companies, whether they issue bond or not,
Yeah.
and we didn't do that. In this case, it was all 46 countries, every possible things that who are going abroad or not.
So do you think that there is a selection bias or some endogeneity there? It's a question.
Yeah, sure. It's a valid question.
And I
Not-
would
yeah.
have think I would have used the foreign share ownership as an instrument for
I
that
sent an email, they still do.
That
material. Why would I go in the US versus
no,
the-
I cannot take foreign share as the instrument, because foreign share would be directly related to the yield.
If I have a US institutional investor in the company, then it's a justification to go.
Yeah,
the
that
other
would be self-selectivity bias. I think it's worth it. Now, instead of being defensive, I'm open to check it out to see is there a self-selectivity bias in the process. Yeah, fair. As you can see, the results are even stronger when we create the index. And I shared with you the result, 42 to 90 basis point changes in decline in the borrowing cost. And we do all sorts of robustness tests in the beginning, clustering by country groups, exclusion of global financial crisis, alternative measures of voting and aid, and we see results are significant. Then we look at the non-price amount of loan offered and maturity. And you remember that the results we had, that you have a 50% increase almost in having a tie to issuance, and maturity also a significantly longer term borrowing that comes in with the political connections. So then we look at across that if you are a government organization, utility of the agencies of the countries, then you are more likely to be closer to the governments, you are more likely to benefit. And so we see that this is the case for government-related companies associated with the individual countries. The results are more significant for them. Then we actually go and look at boom period and recession period, and you can see that this political effect becomes more important when the countries are in recession. So in some sense, the ability to extract a better price is more significant, and when you are in a not doing well in your own country. Because if you have a boom period, maybe you have no problem getting money in your own country. So when you have a recession, that's the time you have really can use the connection with the US and go there and get the benefit. Then we sort of try to explain this paper through the channels. So why these results we are seeing, we're trying to show the channel through sovereign risk hedge. So in some sense, it should be stronger for bond issuance in countries where sovereign risk is high, for lower periods of growth, higher levels of sovereign debt and ratings. And we also show the investor protection channel, which I kind of implicitly mentioned that is a put option is for your investment protection. So we kind of talk about that the effect should be stronger when there is investor protection is weak. In this aspect, we find a very interesting ruling in the Supreme Court. It's a Morrison versus National Australian Bank. This is a court case. It started in 2001. This mortgage company is actually bought by Australian National Bank, the Australian Bank, and they found out that this company has a fraudulent higher valuation when they sold the particular company. So later on, they came and created a court case, and it went all the way to the U.S. Supreme Court, and all Supreme Court have voted for unanimously for the defendants to in their favor, and it means that after this regulation, the companies are not subject to litigation. So in some sense, if they simply mentioned that this is an Australian matter, this is an Australian company. Now all these shareholders are Australian. So even though it's a U.S. company, you cannot litigate this thing in the U.S. So what happens is that after that, any other companies coming in, it depends pretty much on the enforcement of the U.S. SEC, and that creates for us to see some difference in difference. So I show the result. The boom and recessions are defined. Okay, I don't have to go through this because you guys all know that. So I look at these things between boom period, recession, high debt countries, low debt countries, high sovereign debt, low sovereign debt ratings, and we find that results are showing up that political ties have a stronger effects during recessions. You saw that before also, that when the economy is not doing well, it is more strong in the highly indebted countries and high sovereign credit ratings. So result telling us that political ties serves as a hedge to sovereign risk when the potential cost is large. Then we go to the investor protection. Investor protection perspective, we look at high creditor rights, low creditor rights, and we see that the covenants, because this particular paper, there's an RFS paper. The whole paper is about if you have a yield covenants associated with it, what happens to borrowing cost. So we bring that particular aspect, thinking that paper, but we call it here is investor protection, and we find that results are more significant in a high creditor rights environment, and this gives us a perspective that is about investor protection. Then we look at this 2010 our data, and we look at before and after this ruling change as a exogenous shock, and try to see whether these exogenous shocks create a difference. And if you look at the variable here, this particular effect is more significant in the post-Morrison law case environment. So it tells us that these political ties becomes more important after this Morrison National Bank, because after that you don't have any ability to even sue in the US market. So you would pretty much depend on SEC enforcement, and in this particular case, if you don't have a good relationship with the US, you would not be able to make an impact in your ability to raise funds. So here we find that the tie serves as an additional layer of investor protection, complementing other forms. So it is an extra amount of ability to protect yourself. So we have instrument variables. We have two instrument variables. One we are using it, one I haven't shown it yet, because I'll show you I've been using the first paper. This is the second paper that I'm talking to you about. So we have two instruments. One instrument is all the countries that have given soldiers in the Iraq war. This is the political tie with the US. It is correlated to the political tie, but giving soldier has nothing to do with raising fund.
Yeah.
It's exogenous.
It's exogenous in our mind. The second thing we did, we collected everybody who visited White House for the entire time period. So whenever we found out that somebody visited from a given country, we used that as an exogenous shock as a political tie. That is correlated to our variable, but it is not necessarily correlated to the yield. But so giving that, you can see the results are significant. Using the instruments. First stage, you can see results are significant with the square term also, and this is. Now, I don't want to conclude the following reason, because this paper is about political ties and how it impacts the corporate behavior. But if you think about corporate behavior is a secondary effect, because first effect should be whether the country relationship has an impact on country's own sovereign ratings. Because huge amount of money is borrowed by the country itself. So now, to be honest and fair, we did not decide yet how to tell the story. We cannot tell the story about sovereign ratings and corporate borrowings in the same paper. But my first idea about this particular idea, it was based on this particular paper and exactly the same motivation and so on. And here, simply by thinking, if you have a political tie with the US, do you end up getting a better ratings, and do you get a cheaper sovereign ratings? And if you know this motivation comes in, you can see from the sentences I quoted over here, you know who said that, right?
Yeah.
It is not something you have to worry about. It is directly coming from the President of the US in the United Nations General Assembly, and say, let them vote against us, we'll save a lot of money. We would not give money and so on. So, so creating that motivation, we have actually taken exactly the same motivation, and you can see simply from the graph here, by looking at below median voting, above median voting, and so it's over here, and you can see higher is the GDP, lower is the ratings, lower is better, and you can see overall that if you are below median and above median voting, you can see the results itself showing up from the color. But let's go and see this results. So you don't have to see anymore anything I have talked about, although my literature review here is different. I brought a lot of the econ paper here. So this paper I have written completely with the econ literature, with the mindset that it's going to go first in the econ good journals and see whether I'm successful. Whereas the other paper is written completely from the perspective, it's a finance paper, it's about corporate borrowing. But here, all this we tied about paper. So one of the best papers, even though it's a finance paper, is Garmai's paper. They looked at the financing of microfinance institutions. All the microfinance institutions in the world, their ability to raise money, getting money from the US, is related to the relationship with the US. And we take the papers of these, all the papers here are related to economics paper, whether it is aid on economic growth and development, and Alsina and Dollar and Alsina, whether this sort of papers are our motivation in tying the literature with the growth literature and political economics literature. So if you look at here, over there when I talked about A and B, here we're saying something different, but here, sorry, it's US voting over the 50, 60 years, and so on. These are different countries and details, but you'll see here we are looking at this is our key variable, the voting index, and these are economic aid variable, and we create a principal component from all these variables as well as these two voting variables, and we do this vector analysis, and then we look at similarly two variable ratings as well as cost. And you can see exactly similar results here. Every possible way, all the variables. And then we look at next time to the variables with regards to sovereign ratings. And then we see it with regards to the cost of fund. All possible variables are significant. Sorry. So here, an increase in aid by 1% GDP leads to one-notch upgrade, but increase in UN voting, increased US leads to a two-notch upgrade. And as you know, two-notch is a 1/4, it's a huge amount of money. So if you think about if somehow tomorrow in some countries which are in financial trouble, if they can create two-notch upgrade on their sovereign ratings, it's a huge amount of money. And and these numbers go up significantly higher when we do the instruments and bring the instruments into the picture. You will see in a second.
But isn't that voting correlated with all sorts of other variables, really, about their relations? I mean, their policy stance, their political stance.
Of course.
I mean, the experiment, I wouldn't believe it that, suppose I just change my voting a little bit. I'm Venezuela, but I vote in favor of U.S. resolutions. Will the U.S., will that change my, you see what I'm saying?
Yes, I am with you.
Or
See,
even Turkey, I'm a little bit more friendlier to the U.S., but I do all sorts of other things. Not necessarily against the U.S., but, I do all sorts of other things that are kind of independent.
yeah, if you ask me, everything is possible.
Yeah.
All we're trying
So
to
I'm
say,
saying is that might be overstated because it's kind of like, or I don't know how to say it. It's correlated with other.
yeah, I think we are,
We have like clusters of countries,
yes.
that vote together. They send troops. They trade more. Have you put in like trade?
Yes,
You did put trade.
trade.
Yeah. They trade more. They have more cross-border flows.
Yes,
things
we
like
have
that.
bilateral trade agreements. So happens is that,
So I would think those would be.
Yeah.
So could you then look at clusters of countries, maybe? I mean, as opposed to looking.
I can look at it. So what happens is I'm not
Yeah.
trying to hide behind them. So
Right.
if you saw the literature, right? So all these papers that I'm looking at, so let's say Alessina and co-authors is showing that the ability to get money from the IMF
Yeah.
is significantly associated with their voting pattern in the UN. So I don't have to prove the component that you're mentioning.
Yeah.
We are hiding behind those papers because they have extensively doing this work for a long time,
Right.
and we follow them. So in some sense, your point is valid, but we kind of feel that we don't have to
Yeah.
worry about it because the entire literature is doing that, and these are serious people.
Right.
And so I'm hiding behind that a little bit. But let me go back to C. So you are saying that, Iftikhar, why don't you look at a group. So we create a variable, for example, the neutral voters. So we look at countries like Norway,
Yeah.
Sweden, Denmark, and so on, and they're explicitly neutral countries and
Right.
so on.
Maybe
And
deviations from that.
yes, exactly. So you will see some results
Gonna do
coming.
like that.
Yes,
Okay.
but you see that in that case you're right. That but the overall result still holds. But I think you motivate me to think about something. That why don't you look at that those who have voted continuously with the U.S. entire time period,
Yeah.
like UK and Australia and
Right.
so on, and then look at somebody say completely did not vote with the U.S. at all, and
Yeah.
the two extreme,
Right.
and then take in the middle a group which has
Maybe
gone
like
both sides.
Turkey would be an example of a country like that. Sometimes with the U.S., sometimes against it.
Yes,
You know.
and then that these three groups, is there systemic differences in the changes?
Did you control
I'll do that.
Did you control for the political regime in the countries under study?
Though I did not look for is the similarity or dissimilarity between U.S. regime and the other regime. Means I don't have the left versus right. There are some data available to see. Let's say Obama is in power, and Republicans are in power. How that correlate to the country which is in power, and did not control for
There
that.
are rankings for countries from the World Bank and the like proportional
Yes,
representation.
yes. Penn State University has a polity variable, and we can use that. But the reason I kind of think we have somewhat taken care of, so we use a variable called democracy.
Yeah.
So in democracy variable, the way this index is created, they include even that component that whether you're on the left or right by looking at the voting pattern of the left and right in the country. So that's why I kind of didn't take it, but it is feasible to do that. Yeah, feasible to do that. So we look at the yields, also has a significant lower yields. And we do not only one, we go to S&P, Fitch, Moody's, all different other ratings separately, and see this is not only one rating, the results show up in all possible ratings. It's not surprising because, as you know, the rating agencies are quite similar to each other. And
the magnitude of the coefficients are quite different.
different for Moody's, right?
Especially for Fitch compared to the others.
Yes, I think Fitch is a little bit a junior partner, right, compared to this. And interestingly, you'll see if there's in Lebanon, if there is a rating agency here from these companies, they do all the work on analyzing what should be the rate. But they don't have the decision to decide the ratings. It goes to New York. Now, I talked to the New York office. They were a little bit defensive. They said, no, it is not, even though we decide, we create a team, and the team includes somebody from the country and somebody from the outside country also in the team. But I was not trying to be journalistic. I was trying to say that how many members do you have? And they mentioned that it could vary based on the need. And then they mentioned that, which I take their face value, that they said that they randomly bring people from different areas. I don't expect them to say something different because their entire business model depends on being a monopoly in this particular business. And my intention here is also not being inquisitive too much to see whether it's right or wrong. But my curiosity exists that it has a huge power structure. So much powerful that if you want to bribe somebody, a country, you can bribe overnight $1 billion by simply changing the sovereign rating by a few basis points. And how come this temptation is not being exerted by powerful authority? And it's normal, which way they do that.
But we already know that they inflated the ratings of all these, subprime mortgage, the MBSs previous to the global crisis. So, the relative rankings, it's not clear that, let's say India's rating is so much worse if you take into account that like some of these UK or US ratings were overrated.
It is.
By Fitch and these other
Yes.
Moody's, right? I mean, there were a zillion papers on this. after the global financial crisis.
Absolutely,
But
absolutely.
these guys basically just like were fraudulent
Yes.
in their behavior.
Or at least they are joining they're doing this bid for the corporations, and so one of the
Well, not fraudulent maybe, but they overstated.
Yeah.
I mean, all these instruments, I don't know about corporate bonds, but, or sovereign bonds, but certainly the instruments were very badly
Of
valued.
course,
right?
of course.
Their value went down to zero. MBS, are MBS traded now?
So
Are they traded now?
yes, it's back again trading,
Are
again
they-
in high positions, exactly the same thing going on that it happened in 10 years ago.
CDOs,
CDOs,
they're
CLOs,
still being traded?
absolutely,
They have good ratings now?
absolutely.
So,
So-
let's wait to see the next financial crisis.
Yeah, so one interesting part
I
is
mean-
that after the crisis, the best time would have been for somebody to enter in the rating business.
Yeah.
But these corporations did not allow that. They significantly kept this thing. So now there are actually 9 other companies got permission to do ratings. So they have so much power. So for example, there's a significant rating agency developed in China.
Yeah, that's what I was going to say. I mean, these other big sovereign countries are now developing their own
countries,
rating
yes, but-
agencies because they're kind of tired of this,
This under the complete monopoly of the 3 companies.
of the New York companies or whatever.
Absolutely,
Yeah.
absolutely. Actually, if you ask me that why New York City is such a popular destination, it is not because of the equity market. It is about the rating agency. Because everybody borrows money. When the university develop a building, you issue a bond. If you're a small municipality, you issue a bond. And you always have to see whether your ratings are coming or not. So everybody visits New York City to talk to the rating agency to say the rating is not changing. So it's a huge power. So one of the public policy issue from this paper is thinking about that there should be more competition. But here we are not going there. We're simply trying to answer a small question because all of you know in publishing the paper, I have to be very focused about the research question. All we are saying is it is worthwhile to keep a good relationship with the US at your country state to state level. It has a benefit that comes in for your own ratings, for your own borrowing, and even your corporations if they decide to borrow. And here we get the instruments here on both commitment of US troops and as well as the White House variable. And when we use the instrument, you can see upgrade is huge. And 2 to 5 notch upgrade. So then we go and take the next the variable on the yields. Also, you can see huge impact on the yields, not only on the ratings. So you can see it's a 5% lower sovereign yields, 6 to 11% lower yields.
Is there a time delay? Is there a time delay between these spreads increase?
We're taking 1 year.
1 year.
Yeah.
So 1 year after that, you will significantly find the
Yeah.
effect.
Again, related to this question, is there an effect of the time between the voting and the issuance?
So happens is, it's a good question. So the way the data is created is some sort of trend created in such a way that we only take the votes, we don't take every votes. We only take the votes that US considered them to be important votes in the UN. And they have a list and they're considered important vote. And so we got that list, it's publicly available data, and we use that one. But more specific to your question, that it would have been very nice to see exact timing. This vote took place in this particular time. And so, but the way this data set is created, these individuals who have done it, they spend a big chunk of their career in building it, and they do not allow us to go into that route, and we don't have the ability or power or interest to go to that specific, but it would have been very nice to do exactly each quarter by quarter or month by month to see new issues coming in. So overall, in this idea that we are trying to share with you is that you have seen papers where individual countries, political connections give you a privilege to get things cheaper. You have seen that and he's a large number of papers in the US these days, right? If you are in the Ways and Means Committee, member of Parliament, or if you are in the Bank Supervisory Committee in the US Congress, how you have a different ability to get a benefit. And in this particular case is the first paper that actually looks at the issues related to state-to-state relationship in politics and tracing that to see whether it is feasible to reduce the ratings for your sovereign debt, ratings for your corporate debt, and other non-pricing effect. And we don't have a significant exogenous effect as much as we wanted to, but we try our best by bringing some instruments. In the first paper, we brought the Morrison versus Australian National Bank, and each possible cases result hold. So we are comfortable, but we have not finished these papers. As I mentioned to you, it's the first time we are taking it out, and Laila really wanted to see this paper.
Just for
And yes. I was trying to give a paper on China, and she said, no, I want to see this one. Yes.
They would not be happy.
No.
Just a question. It's a silly question. Did you try to see whether the US aid flows and the change in the US aid flows could be a channel in the association between the UN voting, similarities, and the credit rating? Because to me that would be a lead lag.
So in the second paper, we actually do a simultaneous equation.
Yeah.
So first we look at the aid, and then bring the aid and the ratings, and see the result also there, but the relationship is not as significant. So in our story, we want to use that as a political thing. But for our own idea on this one, because exactly, I get the aid, aid gives me more economic environment, more economic environment does that, and we do some estimation. Yeah. Yes. Muhammad. Yeah.
I have two questions.
Sure.
The first question is the political tie that you are saying here. Could it be possible that this is just because countries are sharing similar political ideology? So, for example, don't you think that we also need to look at, so when we see the UN voting, for example, don't we also need to look at who is placing this in the proposal first? So is it the US or Israel or somebody else? Because I think if the initial proposal is by US or, for example, Israel or whoever close tie, then I think you can say that whoever is voting, they have a big pressure to keep the political ties, so to make it more exogenous. So that's something. And my second question is, did you look at the country level lobbying? Because many countries, for example, especially developing countries, they use lobbies to get even World Bank funding or something like that. So I think that might make this a little bit more endogenous because
Fair. Well, your second point is fair. I have not control for lobbying because that data is available. So in the sense, each country amount of money they spend in lobbying, I can do that. But the first one is a question that maybe a political scientist might be more interested to see who is doing that, how that impacts a particular resolution, which country, and so on. Because our question is more about, I want to borrow money, and do I get it cheaper or not? And so in this particular case, whether this relationship works or not. In our case, I think our paper is significantly better than dummy variables. If you look at Marsha Faccio's paper in AER, it simply looks at a dummy variable. If that particular country has a connection with the political relationship with anything, right, a board of director, a dummy variable, and that's there. So here we feel our political tie is a stronger variable, and our dependent variable is more relevant because we are looking at in one country, everybody is raising fund. All the other paper is showing that if they're raising fund in their own country, how politics matter. In this case, the heterogeneity is actually not helpful. So we are thinking about everybody's coming in one country, $1 denominated, one regulation. Here, the political connection is distangling is better, and that's what we are doing it. But I will take your advice on the lobbying part.
Just out of curiosity, how correlated are US aid flows with World Bank, IMF funding? Are they?
Do not know.
So basically, because my line of thinking is maybe they don't need to go through the US aid. So I can give US aid to countries which are not necessarily very much in tune with me, but deprive them from the bigger pie, which is IMF or World Bank.
Yes.
So the real punishment would be
Yes and no. Remember one thing. The contribution of the U.S. in the World Bank is so high that they always will have the president from U.S. World Bank president, right? And in the IMF, the percentage of SDR rights they have is significantly high. So even though the IMF chief is from European countries so far, it is going to go to a developing country from last commitment, but US still have significant power. So in some sense, the paper that I mentioned is AER paper. They show that voting rights have associated with IMF funding. So in some sense that if US does not want money to give to someone, they exert tremendous amount of pressure on the IMF and World Bank.
they should be positively correlated.
Yes, I mean, for some sense, if you think about that, it's extremely smart development for China. So China has created an Asian Development Bank, contrary another bank. They are working closely with the World Bank. They have a construction bank because this World Bank is pretty much in power structure of the post-Second World War, of the powers that win the war, and Japan is ruling the Asian Development Bank. So in some sense, anything you want to do, they have the control. But the money is in the hand of China. So China has created, and then you can see that World Bank, even the current World Bank president, is working very closely with the Chinese Asian Bank because the resources are in the hand of China. So China has been very smart because they figured out they cannot go around and get the voting power and be in charge. So they created their own bank, pretty much. So,
It's happened
yeah.
with the rating agencies too.
Yeah,
I mean, it's already happening, as you said, but it's going to increase.
yes.
People are going to have their Turkish bonds are going to be rated in China or something like that.
It is.
In
But
the
the,
next 20 years.
yes, the issue still that US rating agency still has some monopoly is that even in Turkey, a lot of the foreign institutional investors, they still have a higher respect for American
Right.
rating agencies.
Right now, but I'm saying in the next 20 years. This
Yes,
is-
yes. In that case, rating agencies developing country has to show that they can withstand the political pressure.
Right.
And once it happens, you'll see their
They do it
ratings.
neutrally,
yeah.
Objectively.
Yes, yes, absolutely, absolutely.
Just a final note.
Yes.
Do you think that Iranian corporations should go to the US and issue Yankee bonds?
I would say that politics aside, right? The regulation, if it is a sanction, that's a different issue. Do not know how to answer that. But if it is a open market scenario for Iran to come in, I think that energy has money involved, right? So they'll be able to raise fund. Yeah, I'm sure. But now it is not legal. now it is not legal, because yeah, that's a big issue. That's a big issue. So in conclusion, that it's a very humble effort, but significant time and effort we have put in to see whether we can tie the state-to-state political ties shows up in borrowing cost and non-financial, non-pricing effect, and we find significant effect, and we will try to see whether we can sell it.
Beautiful results.
Any question, guys? No?
Okay, thank you so much.
Thank you very much. Yeah. Thank you.